Hello, everybody. It's John Llodra here. I'm a co-founder and partner here at New Harbor Financial Group for a timely take. These are short take, periodic updates we provide based on something really actionable and timely in markets. Hands down, the most timely news headlines of today and recent days has been the change in messaging by the Federal Reserve as relates to their anticipated interest rate policy as we proceed throughout 2024. There were some notable speeches and comments made last week by several Fed officials, including Chairman Jay Powell. And these are rather, spooking markets a bit and confounding markets, I should say. So let me first just get some backdrop. If we rewind the tapes to late 2023, the Fed was starting to message that they anticipated that they had made enough progress on inflation that during 2024, they anticipated they would be able to begin to start to cut rates. And at the time, they communicated an expectation of cutting maybe 3 separate cuts of about a quarter percentage point each cut. So 0.75% in cuts throughout 2024. The market actually took that and ran with that quite dramatically. And actually, the market expectation said, we think the Fed is going to cut quite a bit more aggressively than that. In fact, at one point in late 2023, the market was assessing probability that the Fed would cut a full 1.75+%. So clearly the market was way ahead of what the Fed was messaging. And over the last several weeks and months, the market has slowly and perhaps begrudgingly come into line with what the Fed had been messaging, just in time for the Fed to start singing a different tune last week. And that's exactly what's happened. And I'd like to share some headlines from last week just to give a flavor for that. So this is a headline on CNBC from last Wednesday, April 3rd. Basically, in prepared remarks by Chairman Powell at Stanford University, he emphasized the need for more evidence that inflation is easing before cutting rates. In fact, he said either in this speech or separately that he felt that the economy seems to not find the current interest rates as being restrictive. That's another way of saying we can wait till data evolves to justify further rate cuts. I scrolled down this article. There was another on the same day. Atlanta Fed President Raphael Bostic basically said that he thought just maybe one quarter percentage cut would be appropriate for 2024, and he pushed that expectation out to fourth quarter. Fed President Mary Daly also kind of chimed in and supported this let's wait and see kind of approach. The very next day, Fed Governor Kashkari took off the prospect of cuts all but off the table if inflation continues to stall from recent readings. And then we go to Friday, and Fed Governor Bowman actually suggested that we actually might see justification for an additional rate hike if inflation stays high. This came finally after the market had finally gotten on the same page with the Fed. So the Fed seems to be, in a little subtle way, pulling the rug out from the market here in terms of over expectations for rate cuts. Obviously, data will evolve and we'll see what happens. I'd like to shine a chart up here showing how dramatically the market has reassessed odds of a Fed cut. This shows the probability, the market's perceived probability of the current rate of 5.25 to 5.5, this target range, remaining in place at the June 2024 Federal Reserve Open Market Committee meeting, which is a couple months away. What you see here is for much of the end of 2023 and at least the first month of 2024, the market was assigning a 0% probability here, essentially saying by June, there was essentially a 100% chance the Fed will have made at least one rate cut. Now, since the beginning of February, this has spiked higher, meaning the odds of remaining at the current rate of 5.25 to 5.5 have skyrocketed such that today it's nearly a 47% chance. That was off of a 0% chance. So basically, the odds of a cut by the June market have been dramatically reassessed by the market. Obviously, it's too early to say what the future will hold here, but it's going to be based upon data and the Fed's evolving interpretation of that data. And on that front, there's been some data that's been mixed, but also some data that really an objective person would take a step back and say that there's no reason or no justification for the Fed to cut based upon this data. So this is a tweet that Liz Ann Saunders from Schwab put out last week, and it basically speaks to, there's been some mixed messaging or mixed data from the manufacturing and service sectors as measured by the PMIs, Purchasing Managers Index. And what you see here is this goes back to the late 90s, and this is the Federal Reserve target funds rate, and then these are the PMIs for services in blue and manufacturing in white. And as you can see, they're both above 50, which anytime the number's above 50, it still means there's expansion going on. When it gets below 50, it speaks to a contraction. But what you notice here, right now, you see the trend of the services is coming down. At the same time, the manufacturing trend is turning up. So there's mixed messaging here. In virtually all other major rate cut cycles, here, you saw both of these trending downward. So this is one data point that suggests that maybe the data is not supportive of rate cuts. This is the Chicago Fed's National Financial Conditions Index. It basically measures how loose or restrictive financial conditions are, looking at a lot of different things, including money markets, debt and equity, and shadow banking and whatnot. Basically, anytime this reading is above this black line, it means they're more restrictive than average. And anytime it's below, it means they're looser than average. And the key here is the trend. You can see that this had been getting tighter, trending closer to more restrictive for much of the last several months, except for more recently, that's been getting more loose. So the financial conditions in the market here seem to be taking a bit of the justification by the Fed to lower interest rates. This is a chart of a proxy for oil prices. You can see this is the turn of the year right here. Oil prices have been dramatically moving higher pretty much all this year. Let's look at some other commodities like agricultural commodities. And I'm just looking at some ETFs that are proxies. Here's the turn of the year. Agricultural commodities have gone through the roof. Let's look at broad basket of commodities, including both the ones I just talked about, but other things like coffee, cocoa, base metals, copper, things like that. Here's the turn of the year, ramping higher quite dramatically. Let's look at gold, precious metal prices. Here's the turn of the year, spiking way higher. Gold is a harbinger of inflation, but also maybe perhaps more importantly, a referendum on central bank monetary policies. And this is a chart that was published by Bloomberg last week. And it basically shows a disconnect between the stock market and market expectations on interest rates. Essentially, this red line is the inverted path of interest rates expected by the market. So when it's going down like this, it means the market expectation are that rates are going higher. And that's this inverted scale here. And likewise, when the red line is going higher, it's the market through late last year, assuming that interest rates were going to be trending lower. And in line with that, the stock market, this is the S&P 500, this black line, had been running in lockstep. But when the market was starting to reassess interest rates starting in about February, we've had this big gap open up here. Essentially, the market, we think, has yet to reconcile this kind of perhaps new reality on interest rates. So that is something that we think will close one way or the other, either by the Fed dropping rates or the market dropping to close that gap. We think it's probably the latter, not the former, that the market will catch down to the expectation here on interest rates. And in fact, the Fed is hard pressed to do anything, maybe not even 3 cuts this year as they originally communicated, unless, and this is a big unless, and we think this is actually a pretty probable scenario, we see a dramatic economic and or market retraction. We think the whole idea of soft landing and Goldilocks is probably off the table. And so we do expect some fireworks that may very well end up in lower Fed interest rates, but probably because the markets are having a hissy fit and selling off and the economy is slowing down dramatically. Of course, we'll watch things closely and have a game plan in place no matter what should happen. But we're in really interesting times, and this timely take just hopefully highlighted a little bit of the evolving landscape here as relates to interest rate expectations. I want to thank you for watching. Certainly, we invite your questions and comments. But until next time, I want to wish you a great day. Thank you very much.